Hey, I'm Cliff Townsend, and I'm host of the Money Show. And in the Money Show, you're going to learn strategies on how you can develop your mindset. You're going to learn how to optimize your opportunities. You're going to learn the art of negotiation, whether you're negotiating with yourself or you're negotiating a business deal. You're going to learn how to create strategies on how to create your own economic plan. And you're going to eventually going to yield the benefits of your hard work, of your commitment, of your sacrifice, and of all the discipline. But before we get into all of that, my guest tonight is a guy they call the non-QM guy. His name is Sal Perez, and he's going to share with you how you can get into, how you can buy investment real estate without having no job, no proof of income, and no tax returns, and even not stellar credit. But before we get into that, I'm going to allow Sal to introduce himself, tell us a little about who he is, how we got into the finance space, and how long he's been in it. So take it away, Sal.
Absolutely, and thank you for the kind words. Yeah, Sal Perez, like mentioned, I've been in the non-QM space now for about 8 years, and it's just been very exciting. The growth seems never ending in this space. I got my start in real estate as a real estate appraiser back in 2001, and I started, climbed up the ropes. Started as a trainee, got my certified license, opened up my own company, and as we all know, in 2008, when the market crashed, so did my company. There goes the market. There goes my company. And I got in REO. I did a little bit of REO asset management and valuation at a company, pretty big company called Bayview Financial. They're still around. And then I was presented with the opportunity to join a non-QM lender, and the rest is history. I fell in love with it once I entered it, and here I am.
So you said something interesting. You said you got an opportunity to join a non-QM lender. What is non-QM? What does that mean?
So non-QM is pretty much all your loans that don't fit the agency conventional traditional box.
So when you
Fannie,
say
Freddie,
agency, when you say non-agency, you mean agencies like traditional loans, like your conventional, the FHA. Is that what you mean?
correct.
And so non-QM would be like what we're going to talk about this evening, like the DSCR. What else? What else would be considered non-QM?
Your bank statement loan is very popular.
Okay, so bank statement loans, what like 1099 loans, all those kind of things.
Correct. Yeah, it all falls under alternative income, what we call it. And yeah, it's your bank statement, 1099, PNL,
Okay,
programs, asset utilization, asset qualifier. We have untraditional methods of qualifying your borrowers.
okay. So it sounds like in non-QM, when somebody cannot get approved traditional ways, there are ways that in none and QM means non-QM means non-qualified mortgage, correct?
Correct. Non-qualified mortgage.
So yeah, so non-QM sound like it would be somewhere where somebody wouldn't qualify, maybe because they have, they work like the Uber, they have gig work, and they don't have all of the things, the W-2s, the 2 years on the job, the credit, and all of those things. But they go to non-QM route, they'll be able to get qualified. Yeah.
Correct. Correct.
Okay. Cool.
Yep. Or yeah, the tax code is 70,000 pages, and
Oh, right.
a lot of self-employed borrowers, they take advantage of that because that's what it's there for. And they write off, a lot of their expenses. They write it off. So when they file taxes, they don't report that much income. So we don't look at tax returns. We qualify them just strictly off their bank statement deposits.
Okay. Cool. Now, what we're going to talk about tonight is DSCR, right? So
Correct.
do me a favor. Tell me, just simplify for me. Dumb it down for me, like I'm talking to a 5-year-old, 10-year-old. What exactly is the DSCR?
So DSCR, the acronym stands for Debt Service Coverage Ratio, and basically is the cash flow of a property has to cover the debt service. So pretty much the rent has to cover the mortgage for it to qualify.
Okay, so the debt, which would be the debt, which would
More
be the mortgage, right?
Correct.
as to cover the rent would have to cover the debt.
Yeah.
Okay.
So if a mortgage, including insurance and taxes, if our total mortgage payment is 2,000, the rent of that property should be 2,000 or more in order for it to qualify.
Okay. And so in a debt service cover ratio, what somebody needs is just to find a property or to have a property that the rent is going to cover the debt. It's meaning that the principal, interest, taxes, insurance, and association, if there's any.
Correct.
And that is what debt service cover ratio mean. Okay. So can anyone use this DSCR strategy, or can anybody use it?
Well,
Is this for specific people? What's the qualifications to be able to use the DSCR or to take advantage of that kind of loan?
So the main qualification is, a minimum FICO. For the lender I work for is 660, and
Okay.
then they need to have.
660?
Say it again.
You said minimum FICO 660.
660, yeah.
Okay.
And on a purchase, they need to have the down payment. There is a minimum, it's since it is an alternative, program, the down payment is a little bit higher than traditional. So the minimum down payment is 20%.
Okay. 20%.
I should note that with the 660, it does require 25%. I just, I don't want to mislead. But with a 700 plus 20% down payment is the minimum down payment.
Okay. So we have the DSCR, the debt service cover ratio. So basically, as long as the rent covers all of the principal, interest, tax, and insurance, that's what qualifies. Now, as far as credit, you need like a 660 credit score, and if you have or 700, you can go as low as 20% down.
20%, yep.
Okay. So can this be used? Can somebody use this for? Let's say I find a property, right, and it meets all these requirements, and I have a 660 or 700 credit score, I have my down payment, and I'll be able to rent it out for more than the debts, right?
Yeah.
Can I live in that property? Can I use it for a primary residence?
No, the debt service coverage is only for investment purposes.
Okay, so debt coverage ratio is for investors only.
Yeah.
Investment
And
only.
and to elaborate a little bit on the borrower's requirements, besides the FICO and the down payment, on a purchase, they do have to own a primary. They do have to have a primary residence that they own, or at least in the last 3 years have owned a primary residence. We do allow individuals that currently do not own a primary and are buying an investment property with the program, if they do have, if they could prove that they own the primary in the last 3 years, and it has to make sense. It has to be. We have to look at it from a common sense, point of view. If they're currently renting, they don't have a primary. The investment properties they're buying, should fit the investment, status quo. It should be inferior to where they're living now. You don't want the underwriter to have any kind of occupancy concern when it comes to underwriting to review. So if they rent a 2-2 condo and they're buying, a single family house, a 3-2 with a garage, and it's in the vicinity where they live now, that's gonna raise a flag.
Okay. Why would that raise a flag?
Well, because it's gonna be an occupancy concern. Because
I'm sorry, what kind of concern?
An occupancy, sorry.
Occupancy. Okay.
Yeah.
So what does that mean?
So the underwriter is gonna, in the grand scheme of things, it's gonna look like the individual is gonna live in that property, and he's using this program to acquire the property for whatever reason. It happens all the time. Their income is not where it has to be, their bank statements are not where they have to be, but they have the money, and this is an easy way for them to acquire a property. But if it looks like it's going to be an owner occupied property, the underwriter will condition for, and we will have to prove why that property, which is superior to where they rent, if they own a 2-2, then then that's
If you
something
look
that,
at that, then what they'd have to do is the underwriter is going to say, listen, make it make sense to me, right? You live in a condo, you live in a one-bedroom condo that you're renting for $1,000 a month, say. Now you're going to buy the $200,000 property where you're going to pay $2,500 a month. You say you're going to raise them, make it make sense to me, but in some cases it doesn't make sense because somebody may not want
if it's a single
want
if it's
to rent and invest, right?
if it's a single man and we have or woman and on the application they have single and no dependents and they live in a 1-1 maybe in a high rise in a hip area or whatever and they're buying 3-2 with a garage in a suburban area, that I could sell. That makes sense. Now, if you live in a 1-1 and the 1003 application has, they're married with 2 dependents, and now they're buying a 3-2, that's not gonna fly.
Yeah,
and it's always
so they'll be able to buy it, but once again they'd have to make it make sense. There's 4 people, you live in a 1-bedroom condo, so obviously you need more space, and now you're buying a 3-bedroom 2-bath house, and you're gonna tell me you're gonna use it for investment, but you're not gonna live in it. So now it may make sense if you're also going to, at the same time, maybe you're renting a 3-2 condo where you're going to live and move your family. Correct. So it just has to, like I say, it just has to make sense, right?
It has to make sense
because this is for investment only and not for primary residence. And so it has to make sense that it's going to show that it's used for primary, yes?
Correct.
Now let me ask you this: can this be used for? I know you say it cannot be used for residential. I mean, not for primary residence, but what about commercial properties? Can it be used for commercial properties?
So define commercial. What exactly?
Well, when I say commercial, I mean anything over 4 units. So, let me back up. Can it be used? Can I use it if I want to buy a duplex, a triplex, or a fourplex?
Yes. Yeah. Now, so we go up to 9 units.
Oh, up to 9 units.
Yeah.
So okay, so up to 9 units in residential, as you know, anything over 4 units is considered commercial, right? So non-residential, so you can go up to 4 units, so up to 9 units. But let me ask you this: let's just say I would want to use this. I want to buy a fourplex. Can I live in one of those units and rent out the other 3?
Not disclosed to me or the lender.
Okay. Right. So in other words, no. Once you buy it, nobody's gonna come knock on your door and say, "Hey,
no, no.
Yeah, but
not that I'm aware of. The consensus in the industry is that nobody does that. No lender goes and knocks to find out who.
Yeah, no lender's gonna, after you close, gonna come back and go, "Hey, are you using all of these 4 units for rental?" You know what I'm saying?
Yeah.
So, but the point is, it's designed to be for investment, right?
Yeah.
And that's the goal. So you can use it for commercial up to 9 units. But what about nothing above 9 units?
Yeah. So 5 to 9 falls in a weird zoning land use space where it's neither commercial nor residential, and that's why you'll see a lot of lenders have 5 to 9. 10 automatically is commercial. That is a hard stop. 10 is commercial, and the lender needs to be a commercial lender. And we're not a commercial lender.
That's why you asked me to define what is commercial. Okay.
Yeah.
All right.
Yeah, because technically the DSCR program, some people view it as like a commercial, a commercial style loan, but it's technically not. It's only on residential property.
Yeah.
No, you can do it on warehouse. We don't do warehouse. We don't do mixed use. We don't do anything where it's income producing or they're going to be, putting a company in that space.
Okay. Not for business. It's strictly residential investments.
Yeah.
Yeah, and I guess that's where a little bit of confusion comes in because 5 to 9 units. Anyway, so why does it not matter? Why doesn't it matter if you have with a DSCR loan? why does it matter if I don't have proof of income, proof of a job, or no tax returns?
Yeah. So that's the beauty of the program. That's why it's so popular. No income, no employment is required. The only requirement, the only aspect that we use to qualify is the cash flow of the property. So, that's why the rent is so important, because that's the only instrument that we're using to qualify the loan.
So I don't have to prove that I have a job, that I'm making X amount of dollars. I don't have to prove that I have income coming in. I don't have to prove my tax returns. I don't have to show you my bank statements. I don't have to show you any of those things. As long as the property, I can show that the rent will cover my mortgage or my debt, my
Yeah.
principal, interest, tax, insurance, and association fees, if there are any. As long as the rent can
Correct.
cover all of those, that's
That's it.
the only requirement I need.
It qualified. Yep. That's why
Okay.
that's why occupancy is so important, because since we're not using any of those documents to qualify, we really don't want somebody living there who we have no idea if they could afford it, because we're not looking at
Exactly. Okay.
any of those.
All right. So that makes sense. That's the reason why it's strictly investment, because you wanted to make sure that the rent is covering the debt. And if somebody goes to live there and they lose their job, then there goes that, right? Or if they're not making enough income, but if the rent can cover it, how do you determine if the rent is going to be able to cover the debt? How do you determine that? I mean, I can say to you, listen, I have this, I don't know, 3-2, and I can rent it for $5,000 a month. How do you determine
Yeah.
that? Whether I'm telling the
So
truth or not?
so on a purchase, we require appraisals on every transaction. On the appraisal of a DSCR, we require a rent schedule, which the form is called 1007. And that form has, similar to the comparable sales, it has 3 comparable rentals in the market area that have recently been rented out, and it's a verifiable rent. And the appraiser uses those 3 comps, makes adjustments accordingly, and from the rent schedule on the appraisal is where we determine the rent for the purchase.
Okay, so along with a regular appraisal, the appraiser also does a rental, like a better word, the rental appraisal, and he or she compares 3 rentals in the area to say, for example, I live in 123 ABC Street. On this community, they're going to do a rent and see what is the average rent in that neighborhood for a 3-bedroom, 2-bath, 2-car garage, right?
Correct.
And then that's how they do the comparison. If
Yep.
the average for the neighborhood is 2,500, and I say I'm renting mine for 5,000, and let's just say somebody is willing to pay me $5,000. Let's just say it's a family member, whatever, and they're willing,
Yeah.
but that wouldn't fly because it wouldn't go. It doesn't go with it doesn't go for the market. It's not market rent. Is that what it
Well,
is?
so if it's a purchase, then that probably won't fly, because if it's a purchase, the current tenant, might not, those terms might not apply moving forward after the purchase. But if it's a refinance and you do have somebody who's renting it for $5,000 a month, and you can show the 3 last canceled checks of the rent, of you collecting the rent and clearing your account, then we will give you the $5,000, regardless of what the appraisal. We still require it, and the underwriter is going to require the 1007. But if it comes in at 2,500, but you could prove that you're collecting 5,000, we're going to use 5,000 to qualify, because that's the true rent.
Got it. So if it's a refinance, if the purchase, it's a little bit different because things can change, right? But if it's a refinance and you already got somebody in that's really paying you $5,000, and you can show, hey, this person has been should pay me $5,000 for 3 months, 6 months, a year, and regardless of what the market says, the market is what somebody's willing to pay. In this case,
Correct.
right? The market is what, if somebody's willing to pay me $5,000, that's market rent, right?
Exactly. Yeah.
For that person. And
Yeah,
for this
that's
property.
that's good for you that you were able to capture, a tenant to pay you a premium. Now, the underwriter might ask why. Is it furnished? Does it include something? Does it include, did you throw in a car for them, or who
Yeah.
knows? But those are things that are relative. You could explain that away, and it's really none of our business. How you were able to acquire that tenant. as long as you could prove the lease and the last 3 months cancel checks.
So you kind of answered my next question, which was, can you use a DSCR for a purchase and also refinance? So
Yeah.
you can use it if you're purchasing it, and you can also use it if you're refinancing. But if you use it for refinance, does it have to be? Do you have to? Let's just say I have this property, right? I have a rental property. I want to take money out. I want to cash out refi. Does it have to be occupied, or do I have to have a tenant in there at the moment?
So that's preferred because if it's a refi and you're telling us that it's an investment, common sense says that it's going to be rented. But for whatever reason, you recently acquired it and you were fixing it, the tenants left, and you're freshening it up and getting it ready for the new tenant. Maybe you had a long-term rental, now you want to do short-term rental with it. For whatever reason, the property's vacant. When the appraiser goes out there, we still allow a cash out transaction. The thing is that there is a reduction to the LTV, to the loan to value, that we allow you to cash out on the property from our max of 75, which if it's $100,000, 75,000, to 70% LTV, which is a 5% reduction in the LTV. So they can still cash out, but just less money.
So if I have a property that's worth $100,000, just for basic math, if I have a property that's $100,000, truly it's appraised for $100,000, and if it's rented and it meets the qualification DSCR, then I can get maybe 75%. But if it's not rented, so that means I can get $75,000, and if it's not rented, it decreases, and I can get 70%. So I mean I can get 70,000 because it's not rented.
Correct.
Okay, so 70% if it's not rented, 75% if it is rented.
And that's actually one of our niches, because there are a lot of lenders that don't allow cash out on a vacant refinance of an investment property. So it's something that we offer that's nice, and even though I wish we didn't have an LTV hit, but it's still nice to offer it.
Yeah, because like I said, there are lenders that don't even offer the ability to do a DSCR if the property is not rented, because it's supposed to be for investment. So yes, even though there's a little bit of 5% in it, at least somebody can still take advantage of it. What is the maximum loan amount for a DSCR?
So that's a great question, and that's why I have my matrices right here. So our maximum amount is going to be $2.5 million.
2.5 million.
Yeah.
Oh, that's good.
But I should say also a disclosure. $2.5 million is the max loan amount, but the maximum cash in hand, which is different from the loan amount, because you could have a $2 million loan that we're paying off, and then you're going to take out money on top of that. So cash in hand, our max cash in hand is $500,000. That you could walk away with closing,
okay,
cold
you got
hard
me a little
cash.
bit confused. Maximum loan amount is 2.5 million. Cash in hand is 500,000. What does that mean?
So if you're, more often than not, the property is being refinanced. There's a current mortgage. There's a first lien on there.
Yeah.
And that lien is going to get paid off, and then the excess is what you're going to take home. Is what your cash in hand.
Oh, so you're saying if I have like a $2 million property, the maximum I can walk away with if I'm doing a cash out is 500,000.
500,000 cash in hand. We'll pay off if there's a mortgage on there for $2 million. We'll pay that off and give you the 500 cash in hand.
Got it. What about if I'm purchasing? It's still 2.5 million. If I'm purchasing it, that's the maximum amount.
Yeah. So if you're purchasing it, we go up to 2.5 million. Correct.
Okay. Can this be used for? Well, of course, we already talked about it. It can be used for single families. Can it be used for condos? Can I do this? Can I use the DSCR to buy a condo?
Yep.
As long as it meets all the same criteria, as long as you can rent it out.
There's no rate hit. There's no overlays on condos. The only thing is, where there is a rate add-on is if it's a non-warrantable condo, which is something that we do allow. That what we spoke about earlier. The traditional agency, Fannie Freddie programs, they don't allow non-warrantable. So a lot of non-warrantable condos come my way.
Okay. Non-warrantable, which in South Florida and a lot of other places, there's a lot of what they call non-warrantable condos, but we're not going to spend time talking about because it goes into so many details about what is warrantable and what is not warrantable. We just know that whether it's warrantable or non-warrantable, you guys can do it, right? You can do it.
Yeah. Yep.
In this program. Is there now? I talked about the maximum amount. Is there a minimum loan amount? Let's say I want to buy a condo. Let's say I find a condo and it's a great deal, and it's worth $150,000, but I can pick it up for $50,000. Will you do? Can I do this? Can I do this loan?
Not 50. No. Our minimum loan amount is 100. Is 100 that we advertise and we promote. I've gotten loan amounts as low as 61,000, but that's an exception, case by case.
Okay, so as low as 61,000. Someone's giving the reason why 61,000 because lenders, it's not gonna make a lot of money. Not gonna miss. So it's the time and effort in doing it for something like like a $50,000 or $61,000 loan, right?
Yeah, I mean, I treat every loan the same, but you're right. The squeeze is not worth the juice on a smaller loan amount.
Okay. Now, on the DSCR, now this is one thing that I get a lot of questions asked, right? Is there a higher interest rate because I'm getting a non-QM loan and non-qualified mortgage, non-conventional? Is there a spike? Am I paying a higher interest rate because of that? Because I'm getting this.
I guess so the short answer, I guess, would be yes. I don't know too much about the agency world. From the feedback I've been getting lately, but this is not the norm. Is that right now we are lower than agency on the DSCR program. Obviously, there's a couple caveats there, like a prepayment penalty and stuff like that we could talk about in a moment. But yeah, for all intent and purposes, yeah, the rates do tend to be slightly higher. Not a lot, but yes.
So maybe if in conventional world it's, I don't know, 7.5, maybe this is 7.6, 7.75, but not major difference.
Yeah, I mean, yeah, right now I could confidently say that there were low 7s to mid 6s. I have quite a few loans right now in the pipeline that are under 7.
Okay. Oh, so yeah. I mean, if we talk about conventional right now, or what you call agency, conventional loans are in the in the 6s, in the mid to upper 6s. So if you're in the same space, then you're pretty much competing with a regular loan. Conventional is just like somebody buying FHA or conventional with good credit, right?
Yeah.
Yeah. So you just brought it up. I want to touch base on that real quick. Prepayment penalty. Are there any prepayment penalties with this loan?
Yes.
It's
not mandatory. We do have options. The max 5 years, all the way to no prepayment penalty. The higher the prepayment penalty, the better the rate. Once you go down into no prepayment penalty, you will see a significant adjustment in the rate.
All right. So we're coming to the end of this episode, right? But just real quick, just in about 30 seconds or so, explain to us what is the prepayment penalty, just so people can understand.
So the prepayment penalty is kind of the lender's security blanket to. So since we don't charge any points on these loans, the only way that we make money is by keeping these loans on our books and making money from the interest. And also when they package them up, that's another show, but and they sell them in the secondary market, loans with a higher prepayment penalty, they yield a higher coupon or a higher return on their investment. So in order to, compensate the borrower for having a higher prepayment penalty, we offer a lower rate. Once the borrower starts saying that they want a 1 year or no prepayment penalty, we know that their plans for that property is to get rid of it. They're going to fix it up and probably sell it as soon as they can. So we're not going to have that loan in our books for very long.
Okay.
So we're going to try to make as much as we can for the short amount of period that that it's on our books.
Okay, got it. So the shorter the time, the higher the prepayment penalty. So if somebody says, "No, listen, I'm going to keep this for the next 10, 15 years," then and if you give it 5 year, then they'll never pay the prepayment penalty because they kept it for 5 years, so they'll not pay the pre. But if they sell it within 3 years or 2 years or 1 year, then they're going to pay a prepayment penalty because that's how you're going to make the money.
Correct.
But it,
I
but
mean,
if they,
it depends. It depends if they initially went in and knowing that, and they got a lower prepayment penalty. But yeah, but if they do a 5 year and they sell it in 3, they're gonna get hit with the remaining. So our prepayment penalty structure is at what they call a step down. It's a 5, 4, 3, 2, 1. So the first year is a 5% penalty. 5% of the remaining balance is gonna be the penalty, and then on the fourth year is 4%. Third year 3%, and so on.
okay, got it. So if I do the 5 year prepay and I kept it for 4 years and sold it in year number 4, I'd only pay 1% on the remaining balance.
Correct. If you have it, yeah, correct. If you have it, if you got a 5 year and you sell it on the fourth, you're only going to pay 1%.
Okay, cool. Now let me ask something as we wrap this up. Is there anything else that you want to share? Anything that I might not have asked that you want to tell us about what it, DSCR? Yeah, anything else that you might want to share as far as is it a good loan? Who's it for? Anything that you might want to share for people.
So it's above my skill set, but in the secondary market, from what I hear, the feedback is that the loan performs great. So it is a great loan, and that's why you hear it's a buzzword, and you don't have to talk too long with somebody about mortgages until they mention the DSCR. So it is a great loan. One thing that I am seeing a lot of individuals who got private money or hard money to acquire a property quickly. They didn't have time to go through the whole underwriting process and all that. They get a hard money loan at 11, 12% interest only, 12 months, 24 months balloon. Now they want to get out of that loan and get into something more more secure long term. They come to me and we put them into a DSCR 30-year fixed, and they get out of that loan that even though they're making the payments fine, but it still has a due date that's coming up and they have to get out of it.
Okay,
so I
I can see how that would help because you have an investor that goes, that don't want to go through the necessary paperwork, tax returns, all of those things. So they go to a hard money lender, right, which is very little requirement, no documentation, pretty much. But the interest rate can be, like you said, 12, 13, 14, 15%. And it's going to be very short term, maybe 6 to 24 months. So now they want to get out of that because maybe want to keep your property for longer. And so then this would be a great transit, a great bridge for an investor who's looking to get out of hard money loan. Is to use a DSCR because now they can come into DSCR, get way better rates, cut their payments down, and do a 30-year, right?
Yep.
Okay, cool.
Yep.
All right.
Or they could do keep still lower their payment and take some money out and acquire more real estate and get out of that.
Right? Yeah. Right. They can take money out, use that money to buy more real estate, and still keep this in the portfolio as the DSCR as a rental, and buy another rental, and so now they can
just keep
expand
it going.
their money, right?
Yep.
And see, this is what we talk about. This is what we talk about when we talk about the money and the mindset, right? And optimizing opportunities, right? And how to negotiate and how to create it. And what you just talked about is how to create your own economic plan, right? And to yield the benefits of your hard work, of your determination, of your sacrifice, of all of those things that you learned, right? And so that's what it is. So this is the end of this show. I appreciate you coming on, Sal, and sharing that information with us. Now, of course, if you want any information and get in contact with Sal, by the way, Sal, how can people reach you?
You can reach me on my cell phone, which always available, as Mr. Cook could vouch for me, and we've spoken at all hours of the night. And my email. I don't know if you want me to say it or you want to post it somewhere.
Well, here's what it is. If people want to reach out to you, they can just click on this link. They can reach out to me somehow, and I will get them in contact with you because I'm sure people are going to have questions about this, and they have some other questions. If you have additional questions, you want to get in contact with Sal. You want to ask him more. You want to learn more about the DSCR and how you can get into DSCR, how you can get into an investment property without no proof of income, no job, no tax returns, and just as low as a 660 credit score. I would have wiped it off the board, but as low as a 660 credit score. Just send me a DM, send me a message, hit me up somehow, some way. This is Cliff Townsend, host of The Money Show, and we're going to see you on the next episode. Until next time.
All right. Awesome. Thank you.